But yes, we might as well begin now. So, hello, welcome to the third Lunch and Learn here. Today we're having Kris Hvamb present on finances, and its topic is time and money. So I will let him go ahead and speak on that. And I'm just going to mute everybody except for Kris, just for easiness, because I can hear some feedback from some people. So one moment. Okay, so Kris is unmuted and everybody else is on mute. If you want to ask a question, you can click on the mute button at the bottom to unmute yourself to ask, or ask the question in group chat. So Kris, yes, go ahead.
Perfect. Well, thanks so much for inviting me, Jeff. My name is Kris, and if you don't know me well, my wife and I, Leanne, run the Primerica office here in town, and we're actually well suited. What we do is well suited to this presentation, because what we do is sit and actually talk to families at the kitchen table and teach them a little bit about finances. And the whole premise is if you know more about how money works, you can make better choices when it comes to money. So what I'm going to talk to everyone about here today is the very basics of building a financial plan, the things that you need to consider, and then the steps that you can take after this, okay? So first of all, is it congratulations or good luck? So if you imagine yourself in your financially successful future, how did you get there, right? Was it because of hard work and informed decisions that you made, or is it just dumb luck? Because a lot of people really don't put a lot of energy or thought into building a plan to become financially successful. They actually trust that maybe random facts are going to make them financially independent. So there are a lot of people whose basic retirement plan is, I want to buy lottery tickets until I hit it big, right? Not a lot of people do it. So when we talk about time and money, we're really talking about the two main resources in society. And just to explain what I mean about that, okay, we give up our time when we go to work, and the idea of taking that time away from our families and away from the things that we enjoy doing on our own is that we get money from that job, right? Once we have money from that job, what we do is take the money that we made and we kind of use it to buy times that we can spend with our families. So we work in that cycle to gather some wealth, and then we use that money when we have it to go on a vacation and spend more time with family. So those two ideas, time and money, are both connected and related to each other, okay? So how are they connected? Well, it's like roots and leaves. So it doesn't mean that you have to necessarily give up time to get money, but if you have money, you can certainly buy all the time that you want. So when we think about our working lives, we need to realize that when we step away from our families to earn that income, if we're careful with that income and use it correctly, we can actually get to a point in our life where that income is going to provide us what we need to live, which means we've got the time to do the things we actually care about. Okay? So what about coronavirus? What has this done for us? Well, Corona has actually gifted us with time at the expense of, in most cases, for most of us, we've lost money because we've got extra time. But because those two things are related, because we've got time on our hands right now, what we can do is stop, take a moment to think about how we're earning our money and what we're doing with it. And we can actually set ourselves up with good decisions now to have more money and more time in our future. And really, that's what all financial planning is to make sure that you have a plan for building wealth over time. And in the end, that wealth is going to provide you with the time to do the things you care about, okay? So today we're going to talk about the 6 keys of financial planning, okay? And those are, first of all, what is the big picture? What is financial planning all about? Why do I need it? And why should I care, okay? We're going to talk a bit about budgeting. I'm going to talk a little bit about dealing with your debt. We're going to talk about savings and investing. We're going to talk about insuring your assets. And finally, we're going to talk about getting a financial GPS, getting a plan down on paper that'll help us reach a point in our lives where we are financially independent. Okay. So the big picture is, if you don't save money during the years you work and you have a job, you're not going to have any money at all when you're too old to work. And that makes so much sense. And yet, how many people do you know actually don't have a plan right now to be able to save money for their future? So first of all, let's look at budgeting. A budget does not need to be complicated, and it doesn't need to be something that controls your life. Basically, we make money and we spend it. So when it comes to budgeting, we can only make a difference in one of two areas. That is the way that we make money and how much we make, and the way that we spend money and how much we spend. So first question is, are you making enough? And is there ever really enough? Okay. So your two options, if you want to make a change for the amount of money that you have left over at the end of each month, because that's realistically the money you're going to use to build your wealth over time, those two options are to make more money or find a way to spend less of it. So if we want to look at spending less, most of us live our lives on a financial autopilot. We pay the bills that come in and often don't even really look at it. Many of us actually have charges that go across our bank accounts and maybe even into our credit cards, and we're not even sure what those charges are for. So taking a little bit of time to understand where your money is going is going to make a huge difference in your ability to be able to keep on to the money that you need, right? So what you should do is sit down and review all of your bills, okay? Cut out those bills that you don't need and you don't want. So I often share a bunch of stories, and one of those stories I share when I'm talking to a family is that I had come home from work one day, and my wife was lying down on the couch with the TV on because our TV was always on, and she had her iPad on her lap and she was watching a Netflix video. My two older boys were downstairs playing an online video game, and my youngest boy was watching YouTube. So what I realized is that we were paying $82 at the time. Now that same package is over 100 now, but we're spending $82 a month on a satellite package that we rarely used. So we just decided that we could probably do without that. And now we've replaced that cable TV package with just a Roku, which is a streaming app that I use on my TV, and we can pick up anything that's available on the internet to watch. So now we can watch those Netflix videos right on our big screen TV. We've also discovered that most TV channels allow people to watch whatever show they are live, starting the day it's broadcast, the day after it's broadcast live, and you can watch it at any point between that day and the next day that the same show shows up. So instead of having to sit down Tuesday at 7 to watch your favorite show, you wait for that show to be broadcast, and starting Wednesday, you can watch it at any time you like. So when you look at how you want to use your money, that could be one big area that you use that you make a decision to cut back on, okay? You should also be looking at the bills you have that you value, that stuff you actually want, but see if there's something newer, something cheaper, or something better. So when I talk about that, I talk about my cell phone, or actually a starting point would be your wall phone. So many people nowadays have a cell phone, and they also are paying for their wall phone at the same time. And we were doing the same thing. And what I did is I realized our youngest son did not have a cell phone. We didn't feel he was old enough to have it. So we kept that wall phone going. And the idea was that if his friends wanted to call him, they could phone him on that wall phone. Well, his friends never did call him. They would always call me on my cell. So we realized we were spending money on something we never used. So my first step was to phone TELUS and say, hey, I want to cancel my phone line. And they said, well, would you be interested in TELUS Lite? So what is TELUS Lite? Basically, it's the same thing with only 3 call features. Now, we only had 3 on the line anyways, but it's the same thing as your wall phone with only 3 call features. It's just they were going to charge me $24 a month instead of $60. So we did that for a month or so and realized that nobody was using the wall phone anyways, and eventually canceled it. And if you look at those small things, $60 a month on your wall phone, $100 a month on your satellite TV, well, that's $160 a month, which doesn't sound like a lot in 1 month, but over a year or 10 years or over a working lifetime, which can be up to 30 years, you realistically have a lot of wealth that you could use in something a lot better for yourself, right? The other thing we do is sit down and have a look at your priorities. We all have things we'd like to have, some things more than others. Most of us are spending money on things that we don't care enough about to really want to use our money for it, okay? You can look at this. If you really need to save and you want to catch up financially and get ahead of all the debt you've got and build wealth for the future, you can look at those luxuries, those things you spend money on that you may not necessarily want or need, okay? So what is it that you personally would get up to be free of financial stress? And what about your spouse and children? And a lot of people are hesitant to talk to their children about money and finances and budget, especially if they're hurting financially. But the risk we spend if we don't share those conversations with our kids is that they're going to grow up without knowing how to manage their own money. They're going to wind up being trapped in the same hole that most of us are today. Okay? So how about making more money? Well, is it time for you to get a raise? And a big word of warning, maybe right now isn't the best time to approach your boss asking for a raise with the economy taking the hit it has now. But sometimes we're hesitant to ask about getting a pay increase at our jobs, even though we may have worked there for many years without getting one. Okay? Is it time for a change of scenery? And what I mean by that is, Roy Matlock is one of the people in our organization that said a quote that really struck a chord with me. What he said is, it's really hard to get rich if you're doing something that you hate. And what happens is, if you don't like what you're doing day to day at your job, you're probably not very motivated. And if you're not very motivated, you're probably not that successful. And if you're not that successful, your boss is definitely not going to give you a raise. So if you look at the stuff that you're doing day to day to earn your income and start thinking about the stuff you truly care about, maybe there's a chance to get paid for doing the stuff you actually enjoy, which means you're going to be motivated every day you show up, and you're going to have a better chance of building a real income. Okay? Hobby income. Are you the kind of person that enjoys canning? Are you artistic? Are you somebody that has a hobby where you're building knives or putting together go-karts or motorcycles? If you've got a hobby, there's a good chance you can convert some of that hobby, some of your personal interests, into part-time income on the side, right? Rental income. I deal with families all the time that have adult children living in their own home. One of those things that I share with those families is that if we have a child that's working full-time in the community because they're done school, they're working full-time, they're living at home, and they're actually spending nothing for rent, what we're doing is teaching those kids to spend every penny that they get their hands on. And the problem for those children is that if they're spending all the money that they've got coming in, they're not going to be able to make that adjustment to living in the community where they're paying their own bills. So I usually talk about the idea of get your kids to set aside the same amount of money that it would cost them if they shared an apartment or a townhouse here in Fairview, but take and set aside that amount of money each month so then when we move out, they actually are able to do that without a big adjustment to how much they're spending every month. And the bonus is the parents can always take that money and use it and save it for the child so they've got a bit of a nest egg when you move out, right? Likewise, maybe you've got a room that you're willing to rent to one of the students at the college. Okay. The last thing I talk about is there is such a thing as a gig economy. And I've heard that term before, finally figured out what it means. What the gig economy is that a lot of people nowadays simply are not earning enough money for what they're being paid at their day job. In order for them to have the money to afford the luxuries they want and to set aside money for savings, is they need to go out and get a side gig, a second job. So this is where you've seen a boom in things like Uber and people doing stuff from home or consulting or even video streaming. So all of these things, these side gigs, these extra things you might do on evenings or weekends, they can help you build that wealth you need to make a difference in what you're saving. Okay? Dealing with debt. And I'm going to start with the simple one. This is just a strategy that we show families. What I've got here is just an excerpt from one of the things that I show a family when I'm visiting with them. But it really fits and it's nice and simple. So this just shows a typical family that has 2 credit cards. They've got a personal loan, they've got a mortgage, and every single month they're spending about $2,500 on their debt. What we show those families is that most of us will take and pay our credit card till it's gone, leave the money in the bank and spend it on something different. In fact, often they'll take that money that we're spending on the credit card and buy something else on a loan so they got another debt. But if you live that way, what's going to happen is you're going to be in debt for a total of 25 years, and the bank is going to make $205,000 off the interest payments on the loans. So we say to that family, take that credit card payment, take all your debt and lock in your minimum payments. don't reduce that. The challenge with a credit card is if you pay the minimum balance this month, next month they make that minimum payment smaller. So if you keep paying that $180 a month, your debt will be paid off quicker than if you keep reducing the amounts. And when that's completely gone, take that $180 a month and add it to the payment on your second card. So now you're paying $930 every month instead of $750 on the second credit card. It'll get paid off even quicker. When that money is gone, you're going to take that money now free and you're going to add that to the payment on your personal loan. And once again, when the loan's gone, you're going to add that to what you're paying for your mortgage. So that whole time, you're just spending $2,500 a month without making any changes. The difference is going to make is that instead of being in debt for 25 years, that debt's going to be completely gone in 10 and a half. It's going to save you $112,000 you'd normally give to the bank in interest. And once that $2,500 is gone, in this scenario is for a couple starting at age 30, they're now 40 and a half years old. If they take that $2,500 a month and they start investing it, and they got 9%, by the time they turn 65, that 9% growth from their investment would give them about $2 million. So we show families that just by organizing your debt and thinking ahead of time, making sure that you're not adding to the debt, don't run up those credit card balances where you're paying them, but just by locking in the minimum payments, you can be debt-free sooner and start saving money sooner. Okay. A couple of other ideas. You can consolidate the existing debt that you have. And what that does for you is each month, if you look at every one of your bills, you might be spending a total of $1,500 on different debts that you have, even $2,500 like that example up above. But if you can take 2 or 3 of those debts and roll it into one, instead of spending that $2,500 a month on debt, maybe you can reduce that to $1,800. Once you've reduced that to $1,800, you can take the money you save, that extra $700, and use it to pay that debt quicker. So by freeing money, you can actually pay your debt off a lot faster. Okay. Big tip with debt and with getting loans, go to your bank that you prefer first. Ask them about what they can do for you. After you've got their offer, go and talk to a broker. A mortgage broker or a loan broker, what they do is they deal with many different institutions and several banks. They'll go out to the people that offer debt, will take care of the debt for you. They'll deal with them and come back and give you a list of what they can do. Once you've got the best deal that you can from your mortgage broker, go back to your personal bank and see if they can match you. In some cases they will, in some cases they won't, but will come as close as they can. And if you really like your bank, maybe it's worth staying there for an extra % or 2. Okay? Consumer proposals. A consumer proposal has to be done through a licensed insolvency broker. And what they are is you can go with a list of debt that you cannot manage. And what they'll do for you, it's usually an accounting firm, what they'll do for you is they will go to every person that you owe money to and make a proposal to them saying that you owe $10,000 on this loan, but because of your financial situation, you can't make those payments. So what they'd like to do is to arrange for you to pay less than that full amount. The trade-off is if they don't accept that proposal, well, you may be forced to go to the next option, which is bankruptcy. And basically, if person goes bankruptcy, that credit institution can get none of your money at all, okay? I put a warning for both of these because they do have long-term implications on your finances. So before you take those steps, make sure that you've talked to a couple of organizations to make sure it's the right thing for you, okay? A couple other random tips that I like to throw in when I'm talking to people, okay? There is a difference between fixed debt and revolving debt, and that difference is a fixed loan will apply the interest on the loan 1 or 2 times a year, whereas revolving loan adds it several times a year. So the best example is on your house or your car, those loans will add the amount that you owe, that accrued interest, once or twice during the calendar year. Whereas if you have that same amount of money owing on a credit card, they will take the amount of interest, divide that by 365, and add the interest once every single day of the year. So because the money you owe on day 1 of the year is compounded on day 2, et cetera, all the way through, the actual effective interest rate of revolving debt is way higher than fixed debt. So that's another argument for debt consolidation. If you can take a couple of credit cards or a line of credit, which are all revolving debt, if you can take and consolidate them into a personal loan that has a fixed interest rate attached to it, you can save money just because of the way they add interest, add the principal onto the, add interest on the principal of your loan. Okay. Another thing is co-signing. The way debt works is banks make a decision on whether or not to lend money to you based on your income. They don't like to debt service someone where too much of their monthly income is going towards that debt. And you see a lot of families up in our area where there's a primary income earner and a secondary income earner. Sometimes it's even a stay-at-home spouse. The banks love to have both people signed on the loan because then they can pursue two different people if the loan is in arrears. But if your income, if one person's income enough to service the debt, and you only have the debt attached to one person, down the road, if you have some financial difficulties, only one person needs to use or consider a consumer proposal or bankruptcy. So if the bank, if your income supports the ability to sign a loan as an individual instead of a couple, it does make sense to try to get on that loan as an individual person. Okay. Saving or investing. So big questions. Okay, these are what you're going to use to consider whether to save your money at a low rate of return or take your money and invest it. 1, are you beating inflation? So the average inflation rate in Canada is a little bit over 3%, which means anytime you save your money at an interest rate lower than 3%, that money over a year is going to be losing. So the bank daily interest savings rate is about 0.5% for most banks right now. If you're saving your money at the bank at the end of the year, because everything you need to pay for is 3% more expensive, you've actually lost about 2.5% of your money, your purchasing power, okay? Which means, do you really need to worry about beating inflation? Because some of your savings accounts you do, some of them you don't really need to. Here's the example, okay? When you talk about investing your money, so at the bank, you get 0.5, that's promised no matter what. You don't have to worry about it. It's going to be there. It doesn't matter how good the economy, how bad it is. So when you shift and start investing, you're looking at investing for risk or for return, okay? And the big factors there are time, money, and rate of return. So if you think of it as a young child just leaving high school, age 18, well, they're going to have 30 years or more in order to save their money and grow their wealth. Because they have a lot of time, it's easier for them to take on a higher risk or better return type investment. But as that same 18-year-old child gets older and they're up in their 50s and 60s, well, now because the time they have to continue saving their money is shorter, they really want to choose something that has a lower return and not as much risk involved, okay? The money part of that factor is how much are you investing each month and how much do you have to begin with. So the more money, the less time you need to build wealth. The more time you have, the less money you have to commit to saving it, okay? Last thing is when it comes to risk and return, you have to realize that your goals change according to what you're saving for and also according to how much time you have to save it, right? And because your goals change, you really should be changing those investments to fit what your goals are. Okay, so here are the steps. Step 1, the money that you have in your bank account should be there to make sure you never have to worry about being overdrafted on the account, okay? So when you're got money that's protecting you from overdraft, it really doesn't matter if it's growing over time. Daily interest savings is perfectly fine. You just want to make sure that you don't get dinged with NSF fees. Step 2, especially in this age of the coronavirus and the income disruption that we've got, everyone should plan for having emergencies. And that depends a little bit on how you live and what you spend your money on. And the example I use is if you're in town and you're on town sewer and town water supply, well, if those get disrupted, the town will take care of it. Whereas if you're living in the country and you've got a water well or a cistern and you've got a septic tank, If either of those systems go down, you're going to need a lot more emergency money, right? So there, because emergencies don't tend to happen every month, they tend to take a year or more, you don't really care too much about inflation, you just want to match it. So when I'm talking to a family, we talk about income funds, which is a fund that is 75% or more bonds or fixed income. And the idea of bonds or fixed income is you get the money no matter what. It doesn't matter what the markets are doing. But if you have something that is that safe, it will grow at approximately the same rate as inflation. So you're going to get about 2 to 4% typically on an income fund. Step 2, plan for a crisis. Once you've got enough money saved that you can deal with any emergencies like your water tank going or maybe the tires in your car, those things are emergencies that you can't plan for or expect, then you want to plan for a crisis. How would you live if your income was cut off for 2 or 3 or 4 months? So we usually say to families, you should look at setting aside at least 3 months of your income, okay? Because that doesn't happen every year or two, it's more like every 3 to 5 years. What you can do is build that to grow carefully. So we would talk about a balanced fund for that, which would mean you'd have anywhere from 50 to 75% in bonds, that fixed income, and the rest of it invested for gradual growth. So that's going to beat inflation by a bit. Usually it'll give you somewhere between 4 and 6%. If you're getting 4 and 6% each year that money is invested, that's going to actually beat inflation and your money will accumulate over time. What I say to families is, depending on the kind of work you do and how seasonal it is, for most of us that have steady income jobs with not a lot of change, we're probably safe with having 3 months of that income saved. Okay? If you're working seasonally and you do typically have 4 months or longer off, you might want to target at least 4 to 6 months of your income. Okay. Finally, once you've got an emergency fund in place, you've got your crisis management fund in place, you want to start saving for financial independence. That's that invested money that you have available when you're retired so that you can live the way you choose and use your money to purchase time to do things that are exciting. Okay. So there you're looking at long-term growth. And again, it depends on time and return. But if you're looking at an 18-year-old saving towards retiring at age 65, they've got a longer term to be able to save. They can afford to be in what we would call an equity fund. An equity fund is primarily investments designed to grow with maybe 25% bonds or fixed income or less. So the style of investment that you choose depends on what you're saving it for. And the other major factor is how long down the road do you need it? Okay. Insuring your assets. Well, I often ask people, what is your biggest single asset? And these are the answers that I often hear. Well, their car, their house. Now, those are both assets that they spend money on to acquire, but very rarely do I hear somebody say, well, it's actually my job, my income is my biggest asset. So if you think of it, if you have a job paying you about $50,000 a year, well, in 10 years, that $50,000 would be $500,000. And over 30 years, that is going to grow to 1.5 million. So your ability to earn an income is a much more valuable asset than the entire balance of your house or any car that you might buy. But we don't tend to think of insuring that asset the same way we do about insuring our car or our home. Okay? So when we're talking about insuring income, step 1, do you actually need it? So I see families that have already built their wealth, are financially independent today, which means if they were to quit working, stop earning any kind of income through their activity, stop trading their time for money, that family is still going to be able to live comfortably until they pass on. Well, if you're financially independent today, I would argue that you might not need that life insurance to provide for that event that you should pass on. Okay. Step 2, identify the risks to your income and make a plan to deal with that risk. So the first risk would be a loss of a job. Well, that's where you've got that emergency fund and those crisis savings funds in place. So if you've got enough money saved that you can afford to go without work for 3 or 4 or 5 months, That gives you the opportunity, should you lose your job, to go out and find another before you have to worry. And then the idea is that once you've got the new job, replace that crisis fund so that you can take care of the next time that might happen. Second, for injured, if you get hurt and you're out of work for any length of time, your ability to actually pay your bills and your ability to actually save money are both harmed. So when it comes to injury, you're really looking at disability insurance. And the idea there is pay a small sum of money each month so that if you have a disaster and become hurt or injured, you're able to provide for your expenses without having to worry, okay? So when you're thinking about disability insurance, what if you're disabled at work? Well, most work plans have some form of a benefit package. And if you don't, you might want to look at getting that for yourself. And the other thing to consider is that most disability packages at work don't cover you when you're not there, which means if you were to be out sledding up in the mountains on the weekend and you get hurt there, well, that's not part of your day-to-day work activities. That disability policy at work will not provide for you. A lot of people think that injury insurance is quite expensive, but if you're buying purely insurance for injuries, usually it's a lot cheaper than a lot of people would imagine. Okay. Finally, what happens if you die? Well, the life insurance is money that you're never going to use because you're going to be dead when it gets paid out. So the common sense thing is to look at who's going to be impacted if you're gone. So you go back to that idea that if you're already financially independent and you were to pass on, if you were financially independent today, your family would have the money that they could use in order to live comfortably until they're gone. So life insurance really only matters in the event that the people you leave behind need the income that you're not getting anymore because you're not around. So the first question is, do you need life insurance? Okay. And finally, step 3 is to make sure the cure doesn't kill you. Okay. So remember, the goal is to spend less money on insurance so that you're able to spend more money on building your wealth. And that building of your wealth can be through investments like I was talking about. Some people choose to build wealth through the purchase and rental of real estate. However you're using it, it takes money to be able to grow more money. So if you're spending too much money on insurance and you're just making ends meet, barely going from month to month, you're probably not going to be able to set aside money to grow more wealth. Okay. The last thing I'm going to talk about is a financial GPS. So those are the main things to think about if you're going to plan for problems down the road or if you're going to build wealth for retirement. The reality is that most people don't plan to fail. They fail to make a plan. So when I'm talking about a financial GPS, I'm talking about getting a plan in place ahead of time before that crisis happens so that you're cared for when it does come. So when it comes to your finances, you have to realize that a logical decision usually do a lot better for you than an emotional decision. You also need to keep in mind that you want to keep a balance between debt, savings, and insurance. The idea is you want to be debt-free before you're done your working years, but you also want to have your savings in place so that you're able to retire. And the insurance will take care of your family or yourself, depending what kind of insurance you're buying, but the insurance will take care of you if something happens to disrupt your savings or your debt management plan, okay? But if you're spending too much in any one of those areas, you do not have enough to put into the other. So a couple of final comments, okay? First, nobody cares about your money more than you care about your own money. So make sure that you spend some time doing some research so that you understand better. One of the biggest mistakes I see that people make is when they go and talk to somebody at their bank or at their insurance company, they're relying on them on completely to say, here, tell me what to do. And they blindly follow what advice they're given. But if you understood a little bit more about that process and the products, you could probably make better choices about what product you're going to use, okay? Second, if you're set up well and you're happy with where you're at, it does make sense to come in and get a second opinion, okay? So sit down one-on-one with somebody to go through your situation, your goals, your debt, your savings, and your plan to help you see if there's a way to make that better. 2, one thing that we do as a company is we not only work with people one-on-one, but we can also sit down and do an overview for a family. So if you've got kids, cousins, nephews, or brothers, and they all want to look at getting some more information so they have better choices, it makes sense to sit down and have a financial wellness session. We can also do group financial wellness. This would be for you and a group of employees, perhaps, or it's your bridge club or whatever group, just a group of people that have a connection. And that is kind of general advice, kind of like this, with a little bit more of an opportunity to stop and ask questions for, okay? And finally, one thing that we are doing is Primerica is now running a series of wellness webinars, financial wellness webinars. They're running every Monday at 6 p.m. They're all targeted to be about 40 to 45 minutes. And if anybody's interested in just watching those webinars, and then when they have that information, making any kind of decision that makes sense, you can certainly be invited to that. So the way to do that is to get in touch with myself. Which brings us to questions. And you can see there, I've got both my email and my cell number. If anybody has any questions, or they can certainly either get in touch with me either way. So does anybody have any questions they want to ask, or something else, some other type of information they'd like some information on? This is maybe where I'll ask you, Jeff, do you want to come back in?
I unmuted everybody but me.
There we go.
So I'm here and I am unmuted now. But yes, so everybody's unmuted. Anybody have any questions for Kris? Now is the time to ask. I'd like to note that this meeting has been recorded and will be posted to Facebook. If you, I don't think anybody's face was ever shown in this, but if you want your voice disguised or anything, let me know. But yeah, does anybody have any questions for Kris?
Well, thank you so much for the time again. Did you have any questions at all, Michelle?
I was just wondering, like, how long does it take to do, like, if you were to meet with, like, say, a husband and wife, and then also with a young adult, like our son, like, how long would we need for that?
Well, I find normally the information I share, and a lot of it's the stuff I just talked about now with a few extras, that usually takes about 40, 45 minutes. But I almost have never sat down with somebody not asking some questions. So you realistically, it's going to be an hour before we're done talking about the information. The next thing that I do when I'm sitting with a family is offer to get some information from them so I can go back and make a plan. The idea of that plan is how much money do you actually need to live the way that you want to retire? Because if you knew how much money that was, at least you've got a chance of saving for it, right? So that would take about 15 minutes to collect. So you're really looking at anywhere from 45 minutes to an hour and a half, right?
Okay, thank you.
And actually what you're asking, that's the critical piece, is that there's no families on earth that are exactly the same as anyone else's, which means your starting point and your ending point will be unique to you. And it also means that you're going to have things that you could take advantage of or things that you need that other people don't. So the idea of talking to somebody that has a background in that is they've probably seen things that make sense for other families that might be worth a shot for you, right? So great question. Thank you, Michelle. You have any other thoughts or questions? How old, by the way, is your adult son?
He's almost 19.
Oh, beautiful. That's the perfect time to start planning. We've got 3 boys, and I've had my children involved in making decisions over where to put their money. Well, my youngest boy, I think, was 12. So, of course, to have them, I've actually brainwashed them where they're always going to be savers, they're always going to be aware of investing, which is amazing because I grew up in a labor-oriented family, and I didn't get that same education from my parents. So I always start from where we're at, right? Cecile, do you have any questions there?
No.
Yeah, Cecile's kind of laughing because she's my mother-in-law, and I talk to her about this kind of stuff laughs. How about you, Jeff? Do you have any thoughts or comments or questions?
Not that I can think of.
Okay. Well, I would encourage you, so I've got my email and my cell number down below. Certainly feel free to reach out by cell, by text message, by phone call, whatever is more comfortable for you. Right now, during the Corona shutdown, financial services are one of those market sectors that are deemed to be critical. So we are still open. I'm doing most of what I do now on Zoom. Usually it's a one-on-one meeting rather than a group one. That just respects the idea that you don't want to take that risk of exposing yourself. Normally, we actually meet in clients' homes on evenings or weekends or whenever it works for both partners to be available. So if you wanted to arrange a one-on-one like that, that's certainly available. If you wanted to meet on Zoom, we can certainly do that as well. So, Jeff, I really appreciate your time for this. If anybody has questions after the fact, do they have a mechanism to send them to you?
Yeah, anybody can contact me through my Facebook page where the link was through the events, or email me at ceo@fealtyltd.com, or contact me by phone number. Easiest one is my cell phone is 780-835-9482.
Perfect. And then my cell number and email are both down there below. So thanks so much, guys. Thank you, Jeff.
Thank you. Make sure you guys all join us next week for Michelle Stam's presentation. And so she'll be talking about business branding and stuff, and we'll have much more publicity on that on the web, on the Facebook page. So follow the Fealty Limited Facebook page for more updates. If you signed up for this, you'll also get an email invite. That will be starting next week. I didn't do it for the past 2 because we're just building the list. But yeah, so I hope to see some people out next week. So yeah, next week is branding. The week after that, we'll be doing a cybersecurity lunch and learn, which I'll be hosting.
Awesome.
So thanks everybody for coming.
Yeah,
and just a comment on branding. Right now, we all have, and that's part of the gist of what I was talking about. We all have time. Why not use that time constructively to look at getting better and getting better in all aspects, including your business. So
that's exactly.
I'm certainly going to try and make it, Michelle.
Oh, perfect. Well, I hope to see you.
Awesome. Thanks so much, guys.
Thank you, guys.
Thanks everybody for coming.